And welcome to Armanino's webinar, Accounting for Business Combinations, ASC 805 Purchase Price Allocations. Please remember you will receive a link to the webinar slides and recording within 48 hours after this event. My name is Mary Trussell, and I want to just walk you through how to use your webinar pane. You'll see in the upper right-hand corner of your screen a little orange arrow. If you click on the arrow, the box will expand and you'll be able to enter a question for our presenters throughout the webinar. We will answer those questions as time permits at the end of the webinar. If not, our presenters will get back to you via email following today's webinar. Also, we want to make sure that you've selected the correct audio settings so you do not have an echo going on. So make sure that if you're using your computer mic and speakers, you have selected that option. You can click on the little blue words at the top left of your screen there. So make sure you select either the computer audio or the phone call, however you have logged into our event. And then to qualify for our California CE credits, you must make sure that you are using a personal computer and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions and complete our evaluation survey at the end of the webinar. And now I have the pleasure of introducing our presenters. The first is Dirk Van Dyke. He's a managing director in our Valuation and Equity Services group. And Dirk has more than 20 years of experience valuing companies in Silicon Valley. He's focused on common stock valuations for stock option pricing, purchase price allocation, our topic today, and derivative valuations. Nadia Carey is a manager in our Valuation and Equity Management Solutions group, and she has done valuation analysis of early to late stage private companies, intangible asset valuations for mergers and acquisitions and business combinations, SAS 73 audit assist reviews for Armanino's audit clients, and also handled some forensic accounting along the way. And finally, we have Gunter Hoffman, who's a director in our Valuation and Equity Management Services group. Gunter is worked as a venture capitalist, entrepreneur, mergers and acquisitions advisor, and valuation specialist. And through that, he has valued more than 400 companies in the last 15 years. He leads the corporate finance practice at Armanino as well, and his practice includes software, internet, life sciences, semiconductor, and renewable energy clients. We just want to review for you this morning the scope of our team's experience, and we have valuation for tax and financial reporting compliance experience in IRC 409A, ASC 718, gift and estate valuations, transactions, portfolio valuations, and purchase price allocations. We also serve as a purchaser's representative, provide corporate finance guidance, and help with mergers and acquisitions. And our group has done more than 3,000 valuation opinions over the last few years. During today's seminar, participants will be able to discern the nuances of fair value accounting for business combinations, uncover hot button issues for auditors, delve into the assumptions and methodologies to understand and interpret a compliance report, and review the latest guidance from the AICPA, the Appraisal Foundation, and other standard-setting bodies. And with that, we're going to make sure that you are all involved here and do a polling question to get started. So the first question that we have for you is, are you, your company, planning for an acquisition within the next 3 months, 6 months, 12 months, or not at this time? And as a reminder, we will provide you a link to the PowerPoint slides and a PDF of this presentation within 48 hours of this presentation today. So it looks like the majority of our audience has voted. We're going to go ahead and close that poll. And approximately half of the audience is not yet planning, but we do have a good group that have been looking at acquisitions. All right, and I think I will turn it over here to Dirk Van Dyke.
Hello. So the reason why we do purchase price allocation is for accounting purposes, to put the value of the acquired intangible assets, including Goodwill, on the balance sheet. So there are 4 general steps for this. One is identify the acquirer, which typically is very simple, but occasionally it's not obvious who the acquirer is when 2 companies are merging that are relatively the same size. Obviously, you need to know the acquisition date. 3, where we come in, is recognizing or perhaps identifying and measuring the identifiable intangible assets acquired. Well, also tangible and intangible, I should say. Liabilities assumed, and occasionally, but rarely, non-controlling interests. And the last step is goodwill, measure goodwill, or a gain from a bargain purchase, but that is very rare to see a bargain purchase. Auditors in particular do not like seeing a bargain purchase unless there's very strong evidence that there is one. Okay, the FASB guidance is ASC 805, business combinations, which states that the acquired assets and liabilities must be recorded at fair value. So first there's tangible assets, which are usually pretty straightforward. Rarely we'll bring someone in who is a certified PP&E or fixed asset appraiser to value that if it's a very asset intensive company. It doesn't happen that often. Oftentimes we use book value or might adjust that. The key step here, in my opinion, is identifying and valuing the intangible assets, which is what we're going over today. And then, as we'll show an example soon, goodwill is simply the residual amount of the purchase price. It's what was paid less the tangible assets less the intangible assets equals goodwill. Okay, there's been a study done showing these are public companies, so this is data is gleaned from public company balance sheets post-acquisition. And as you can see, financial institutions, at least in the post-financial crisis era, have very little intangible assets or goodwill. If you look at it, that's as a percentage of the purchase consideration. Only 1% of the purchase consideration is a specific intangible asset, the median, and just 6% is goodwill. Now that's very different. You look at technology, which not surprisingly has very high level of intangible assets, and we'll go over what some of those are later. So it's 1/3 is the median for specific identifiable intangibles, and then a majority of the asset of the purchase consideration is actually goodwill. So it is a future expected benefit that can't be quantified at the time of the acquisition. Okay, so what are intangible assets? So technology is typically one. You can see the different examples of technology there. Assets that lack physical substance isn't a perfect definition because databases exist, right? Computer software, you have the code, but that's really not what the asset is. Customer contracts, relationships. Customer relationships is a much more common one than contracts to value. We do value contracts on occasion. Most of the time there's a trademark or trade name involved in an acquisition, which may or may not have value. Non-compete agreements may or may not have value depending on the ability and desire of the sellers to compete. And artistic creative assets such as plays, books, movies, games, photos. Say someone acquired Getty Images, there'd be a huge value to the photos, for example. One thing that's not up there that I value before is musical royalties from a variety of artists. I valued some big name rock stars royalties, which have been decreasing over as a younger generation gets musical assets for free or for very low cost, as opposed to paying for it like I did when I was their age. Okay.
All right, and now we are ready with our second polling question. And that is popping up here. So what intangible assets does your company have? And you can select multiple options here. So do you have technology, in-process R&D, a trade name, non-compete agreement, and customer relationships? So if you can enter in all that apply to your organization. And we'll give you just a moment or two more to finish that voting. Dirk, we're all curious about the rock stars that you...
And if you had to listen to all the songs.
All right, and with that, we'll go ahead and close the poll.
Well, I'm not supposed to name any names of the rock stars, but one of them had been, the royalties had been declining prior to the gift that this artist made, and then they had a supernatural comeback after that. So give you a little hint there. So we have approximately 70% of the attendees have both technologies and customers as intangible assets. About half have a trade name, 40% in process research and development, which we'll explain what that is shortly, and a little less than 30% in non-compete. So that's about what we would expect to see. Okay.
So I guess there's not a lot of financial institutions on the call.
Okay, so our new slide is up here, and this slide is basically showing you on the upper left-hand corner, there's an opening balance sheet before any intangibles are added. Total tangible assets of 5.4 million. However, a company came in and deemed that it was worth paying $11 million for this company, 10 million of that in cash and 1 million of assumed long-term debt. To get to the intangibles and goodwill, we subtracted off the net working capital and net fixed assets to get to 7.6 million in the lower left corner of intangibles and goodwill. So in the upper right-hand corner, we've restated that balance sheet, added intangibles and goodwill by the magic of an acquisition, that those intangibles and goodwill get added to the balance sheet. Personally, I think that they should be added to internally developed intangibles should be on a company's balance sheet, but probably a lot of the CFOs and controllers on the call would disagree with that opinion. So if you go down to the lower left-hand corner, you can see total purchase consideration is equity plus long-term debt. Subtract off net working, which is equal to net working capital, fixed assets, and total intangible value, which is equal to the value of the acquired business. Okay. Okay, now we're going to break out intangibles and goodwill. So we're just looking at assets on the right-hand side there, and you have the usual tangible assets. That doesn't change. What does change is that post-acquisition, we've added to the acquirers, to the buyer's balance sheet, three specific identifiable intangible assets: technology, customer relationships, and trademarks, trade names. Just an FYI, that's a not uncommon ratio. The technology is worth the most, and the customer base is worth a little bit less than that, and then the trade name or trademark is worth a fair amount less than that. Then we have goodwill, which on the balance sheet would simply be goodwill, but here we want to show that we actually value the acquired workforce as an intermediate step in valuing the most valuable intangible asset. So that's 200,000 here, and then other goodwill is simply the residual to get to so that the total intangible assets equal to 7.6 million on the left. Okay. Okay, now Nadia Carey is going to discuss key elements and challenges.
Good morning, everybody. So we just saw the breakout of the intangible assets and how they get added to the balance sheet. Here we will go over how to combine these balance sheets and what value should the target's assets be listed on the new balance sheet. The first two options on this slide are incorrect. The target's assets should not be listed at their historical carrying cost, which could be zero if it's technology and never made it to the balance sheet in the first place. The second option here is to restate the target's assets at the value to the buyer. And that is also incorrect for the FASB ASC 805 regulations. The target's assets should be restated at the value to a market participant. And this is a key word and a theme that we'll revisit in the slides to come. So here we go. The definition of fair value is the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants at the measurement date. The key words here are that it is the price to sell an asset. It is an exit price, not the price to buy it. The other key word is the market participant. It should be a market-based measurement and not entity-specific or buyer-specific. Market participants should be independent, knowledgeable, and able and willing to transact and not forced or otherwise compelled to. We also have on this slide it's not explicitly stated in the fair value definition, but the intangible assets should be listed and valued as their highest and best use, physically possible, legally permissible, and financially feasible. And we also assume that the transaction would occur in the principal market for the asset. So another key challenge, the reason for buying the asset is not the basis for valuing the asset. Buyer-specific attributes and intent should be disregarded if it's different than other market participants. So here in example number 1, a redundant asset. Say the buyer of the target company plans to cease using the trade name immediately after the purchase, quoting, "There's no value in the trade name for us." It would be incorrect, therefore, to list the trade name on the balance sheet at 0 if other market participants would utilize that trade name.
A good example of that is if Coca-Cola bought the Pepsi trade name and then retired it to increase their monopoly power and pricing power. So that Pepsi being retired, Coke has not using it, but there's a huge value of the Pepsi trade name. So in that case, in that hypothetical acquisition, the valuation specialist would have to value that trade name put to its highest and best use by market participants. So other soft drink or consumer goods companies would absolutely use the Pepsi trade name, so that would go on the balance sheet even though there's no value to the actual buyer.
Exactly. There's no value to the buyer, but it should still make it to the balance sheet. So example number 2 are synergistic assets. If the buyer is uniquely positioned to accelerate sales of acquired technology. That synergistic benefit that's unique to the buyer should be removed when valuing the intangible asset if a market participant isn't able to take advantage of those same synergies. So the financial projections, these should also be based on market participant growth rates and margins. Entity-specific synergies between the buyer and seller should be excluded from the financial projections used in the purchase price allocation. These include advantages, efficiencies, and benefits unique to the buyer and seller that are not available to all market participants.
But if they are available to other market participants, they should be included.
Exactly. It goes both ways. So another step to take in preparing and reviewing financial projections in a PPA is to double check them across industry growth rates and margins, just as a reasonableness test. and in particular, be able to explain any significant differences between the industry and the target company that got acquired. So in using the market participant assumptions, this applies to all of their costs and revenue and expenses and growth rates. So cost of revenue, R&D expenses, sales, SG&A, their capital expenditures, all of these items should be based on market participant level. And that last point there, the in-process R&D, the cost to complete this should also be at a market participant level.
All right, thanks, Nadia. And now we're going to go to our third polling question. Oh, we've got an easy selection here for you now. Have you been asked by your auditor to provide more support for the assumptions used in your projections? So please select one, either yes, no, or not sure. Great, thank you. We really appreciate everybody weighing in here. We're going to give you a couple more seconds to finish the poll so you can get that continuing education credit. And it looks like we have the majority of voters in, so if we can go ahead and share the results there.
So here we can see most everybody voted yes. This is certainly not surprising to us. We audit PPAs and also get audited ourselves, and frequently there is a lot of support requested from auditors, and the assumptions can be very subjective at times, so this is not surprising to us. All right, so moving on, now we'll take you through how a PPA works. So here we have our four main ideas. How do you identify an intangible asset? What is its remaining useful life? What is goodwill? And why are there two kinds of goodwill? And we'll go through this here. So first off, identifying intangible assets. There's two main criteria that need to be considered. Number one, the asset is separable from the rest of the entity, and it could be divided and sold off. This could be either individually by itself or even together with a related contract or another identifiable intangible asset. So if the intangible meets this criteria, then it should be valued separately. The other criteria is that the asset could arise from contractual or other legal rights. And regardless of whether those rights are separable from the entity, any asset meeting this criteria would also be valued separately and put on the balance sheet separately. Examples of this one include operating permits and licenses, or possibly supplier agreements. So the useful life of an intangible asset is another somewhat subjective determination that is made as part of a purchase price allocation, and it's based on a few things, including what is the expected use of the asset, is its life limited due to a legal contract or maybe technological obsolescence, for example. Any economical or contractual factors could limit the life of an intangible asset, and what is the expected useful life of a related group of assets. So here's an illustrative example of the lives that could be applicable to the various intangible assets and what's possible there at the top, and then its life could be shortened by legal contracts or obsolescence, which frequently is the case in technology assets. And that brings us to number 3. After we identified and valued the intangible assets, we're left with goodwill. And it really is the residual value that isn't specifically allocated to any of the tangible or separable intangible assets. So here's the simple equation for that. We have our purchase consideration, the $11 million that Dirk mentioned earlier, and we subtract off our tangible assets, which are working capital and fixed assets, then we're left with the 7.6 million, which is the total intangibles and goodwill. And after we have separated and valued our identifiable intangible assets, that could be the customers or technology or non-compete agreements or what those items Dirk mentioned earlier, say we have valued them at 4.4 million, then the remaining 3.2 million of the purchase is goodwill. And here in number 4, out of that 3.2 million, some of it is allocated to an acquired workforce. The acquired workforce is not listed separately on the balance sheet, and it's not an intangible asset in itself. It's considered to be part of goodwill. So it does get valued as part of a purchase price allocation, but it is listed and included as goodwill on the balance sheet.
So it's kind of interesting to me that it's not included as a separate intangible asset, since in certain acquisitions, such as an acquire to hire a workforce, it's the most valuable asset, intangible asset, actually most valuable asset, period. But the FASB and SEC deemed that it was the valuation methods used to value the workforce weren't sufficient enough to have that being on the balance sheet. So that's why it's not, that's why it's just lumped in with goodwill.
Yeah, that's a great point. And we saw earlier that technology companies tend to have very high goodwill, and they also tend to get hired a lot. So the acquired workforce is typically valued as a replacement cost model. Basically, what would it cost if we started from zero to rebuild this workforce with the same skills and expertise? So here we have what is the impact of having higher goodwill and lower intangible assets versus a significant amount of identifiable intangible assets and a lower amount of goodwill. So if you have a PPA, if you have a purchase with a very high amount of intangible assets that are separately identifiable, this will result in a higher amortization expense over its useful life, and therefore it will have a lower goodwill amount. This goodwill will then be tested for impairment in future years, and any potential goodwill impairment that happens to occur in later years is actually a direct charge onto the income statement. So this could result, if there's very high goodwill, it could result in very high write-offs in later years, and the lower the goodwill, the less potential earnings volatility you'll have in later years, because everything will just be amortized. So going along the same concept, if there is an increased allocation to the residual goodwill, then there's any future impact of goodwill impairment will be much greater. So here are some fundamental components in a purchase price allocation. Our principles of risk, return, and value are ever present in the whole model. Our main risk and return rates are the weighted average cost of capital, internal rate of return, and the weighted average return on assets, which we'll talk about. We have our 3 main approaches: income, market, and cost, and then contributory asset charges and the tax amortization benefits are also unique to purchase price allocations and intangible assets. Here's an illustrative example of a variety of risk and return rates that are applicable to different types of assets. You can see that working capital, the risk and return rate is very small, and it increases as we progress along the chart and we get to the intangible assets. So this is a nice example of how these separate intangible assets carry different risk rates.
So just an example of the potential impact of a goodwill write-off. You may remember back in the internet boom period, the late 1990s, that AOL acquired Time Warner. And eventually, a few years later, AOL had to post a $98.7 billion write-off on Goodwill because of that acquisition was an abject failure.
Yes, so having a large amount of goodwill could really impact your income statement in later years. That's a great example. Okay, so here we have our three main risk rates that are in the PPA. We have our internal rate of return, which is solved for using the purchase consideration and the forecast. We have our weighted average cost of capital. This serves as an industry benchmark, more or less, and it's derived from comparable public companies. Then we have our weighted average return on assets. This is where we weight each of the risk rates that are applicable to the various intangibles that we saw in the previous slide. So we would multiply the rate of return for each asset by its percentage of the total purchase price, and that's how the WARA, as it's called, that's how that is calculated. So here are the three main approaches. Income approach is typically very similar to a discounted cash flow model. It is very commonly used in purchase price allocations. There's the market approach where we would try to get observable data from market transactions of similar assets. This is oftentimes very difficult to get, and their lack of data out there makes the market approach less common in identifying intangible assets and valuing them. And then the cost approach, the cost to recreate an asset of the same or similar utility. This is used, as we saw, in the acquired workforce valuation. It could be used in technology. It is used slightly less common than the income approach, but more oftentimes than the market approach in general.
Auditors typically want to see an income approach, and if an income approach is not used, they'll want to know why.
Right. And here we have the list of all the primary income approaches that are used, and we'll go through them quickly here. The multi-period excess earnings method. This is typically used for the primary asset, the most valuable asset, identifiable intangible asset that is acquired. It's very similar to a discounted cash flow model and includes the contributory assets that we talked about earlier. The rate of return for the asset that's used in the multi-period excess earnings method is a guideline benchmark in determining whether the asset is more or less risky than the company as a whole. So that moving on to the relief.
Maybe a quick comment. We had a question, why would companies even value the workforce? And reason here is that it's a contributory asset, so we do need it as a contributory asset charge in the multi-period excess earnings method, because obviously although we don't value it as a separate, or we don't show it in the balance sheet as a separate item, it does contribute to the cash flow that the company generates, and therefore is a charge in the multi-period excess earnings method.
Right, yep. So it is important to separate out and identify and value the acquired workforce. The relief from royalty method is another income approach where royalty rates are obtained from various databases or contracts that are public. And this is applied to future revenues. So basically the model reflects expenses that are avoided because you do not have to incur the expense of obtaining the asset from a third party. So if you own, this is typically used for the trade name, and if you own the trade name, then you wouldn't need to license one from a third party. The distributor margin method, this is typically used to value customer relationships, and it uses market observations of wholesale and distributor operations to develop inputs for valuing customer relationships. This should be used for, this utilizes companies for whom the primary asset is not customer relationships. The last income approach method on there, the with and without method, is where we would model what the income statement looks like with the asset in place and what the income statement would look like without the asset in place.
So that's often used for non-compete agreements where you would have a financial forecast including the non-compete, and then you would have a financial forecast without the non-compete, and then the discounted differential would represent the value of that non-compete agreement.
Yep, exactly. So as we mentioned, the market approach is less common, and the replacement cost method would be a sort of cost buildup to get to the value of the asset. Here's briefly to go over the contributory asset charges. Gunther mentioned this in our discussion of the MPEM and why would we value the assembled workforce. So the contributory asset charges in the multi-period excess earnings method represent charges for the fact that this asset getting valued, that's the primary asset of the company, still relies on other assets that are in place to make that earnings stream. So charges for contributory assets would include charges for working capital and fixed assets, as well as other intangible assets. So the customer relationships contribute to the value of technology if technology was the primary driver of the acquisition. And therefore, there would be a charge for customer assets, a contributory asset charge at the end of the multi-period excess earnings method that represents the contribution that the customer relationships make to the technology. So here, just a little bit more into the details. The charge is deducted from the cash flows, and this is typically calculated as a percentage of the primary asset's revenue. So typically the charge is a percentage that's just applied in each year. And that pretty much covers contributory asset charges. And the last one is the tax amortization benefit. This is also a unique benefit for intangible assets. It's IRC 197. It provides a tax deduction to amortize the value of the intangible asset over 15 years. So you add the present value of the tax savings and count it towards the total value of the intangible asset. Pretty much almost always, we have almost in parentheses, but it is very, very common that you would assume a market participant would take advantage of this tax benefit. And I'll hand it off to Gunther to go over the next portion of the webinar.
Thank you, and good morning everybody, or good afternoon, depending on where you dial in from. So some specific or some issues related to specific intangible assets. Customer relationships, I think one of the main issues we see is customer attrition rates. So few companies have their customers forever, so there's a finite life to the customer relationship, and that gets modeled with a customer attrition rate. Auditors like to question that, so it is good to have some historical evidence for customer attrition, which of course for early stage companies is much harder than for established companies. And the other piece is often it's not as easy to get that information from the IT systems that the company has. So the more sophisticated, the better. But you have to make do what's there. The other piece is, of course, there's you can compare these the life of the asset of the customer relationship with other transactions. So usually what we do is we look at similar transactions in the industry and review what remaining life of the asset or the customer relationship was, and that should give some insight into the attrition rates that are usual in that industry. The other piece here is that, of course, the customer relationship There is some sales and marketing expense to maintain that customer relationship. I think at a minimum we would expect that you send your customers a card for the holidays, but there are some expenses that go along with that. Next one is technology. We do a lot of valuations for technology companies and technology acquisitions, so that is often the primary asset. Also here there is an expectation that there is some R&D expense that maintains the existing technology, so maintenance R&D expense. I think the other comment here would be that the auditors would question if you have a new product coming out next year that's based on technology, but there's no in-process R&D on the balance sheet. So you would have to provide support for that. I think we talked a little bit about non-compete agreements. There should be qualitative, quantitative support, and not every non-compete agreement has value. So there would need to be a review of each individual, the ability of competing, feasibility, but also the desire to compete. Maybe it's a founder that's retiring and has really no incentive and no will to compete. But of course, in every agreement, there is a non-compete agreement. In every purchase agreement, usually there's a non-compete agreement. Asset life, we already touched on that. I think there you would look at the life of similar assets to get some support for the asset life that's chosen. Then on the next slide, we look at in-process R&D. I think that's also looking at the financial forecast and where does future revenue come from. And for technology companies, it can come from existing technology, which we would expect to see on the balance sheet as an identifiable intangible asset, or it can come from future technology, something that hasn't been developed yet. So there's future R&D, but it can also come from something that's in development, and then we would capitalize it as in-process R&D. There's some requirements to do that. So there needs to be a technical feasibility of completing that asset, that technology, and there needs to be an intention to complete the technology. But a technology is nothing without the ability to use it or to sell it. So that's also a requirement. So there needs to be a probable future economic benefit. And of course, there need to be adequate technical, financial, and other resources to really complete the development. Now, if you have all those factors, then there would be an expectation that management has some reliable forecast of the expenditure to complete the development and of the economic future benefit. If not, in my experience, then the auditor will ask why. If you want to complete it and you can complete it and you have the resources to complete it, and it's more likely than not that there is an economic benefit.
All right. Thank you, Gunter. And we're going to do our last polling question here. And that's popping up here. It has to do with Goodwill. What is Goodwill in the context of this webinar? And you need to just select one choice. Is it friendly, helpful, or cooperative feelings or attitude? Intangible assets not separately identified. Intangible assets such as technology and trademarks. Things people donate to the Salvation Army. So we're going to give you just a couple more moments to select. And it'll be interesting. We've got one answer that's trending higher than all the others here. All right, and with that, we'll go ahead and close the poll. Okay, and are they right, Gunter?
Well, unfortunately, they are right. I was rooting for the friendly, helpful, cooperative feeling. But of course, it's the most intangible of the intangible assets. So it's an intangible asset that's not separately identified. But it's good if you donate to the Salvation Army too. So some recent developments. I think we still have time for this. One, I wanted to touch quickly on the Fair Value Quality Initiative. This is not only relevant for purchase price allocations, but of course that's where it comes to the fore pretty often. This is basically the SEC complaining that there's too much divergence in practice and that there's a bunch of folks out there that may not have the requisite training, qualification, expertise, or experience to perform this valuation work. So the SEC complained and pretty much told the valuation community that it would be good if there were rigorous and uniform qualification, training, accreditation, and some oversight of the individuals conducting these fair value measurements, which led to, and similar to other professional organizations, right? Physicians, accountants, lawyers. There's some centralized oversight for the valuation community, not necessarily. So the AICPA, the ASA, and which is the American Society of Appraisers, and the RICS, which is the Canadian equivalent, came together and established fair value quality initiative and trying to develop a framework for performance requirements, qualification, and quality review. So that's an ongoing process. There's some publications already out there to show what direction that's going into. On the next slide. So I'm not going to go into the details here, but there's going to be some credential, fair value credential, where professionals that do these type of valuations would be expected to have that credential. There will be some performance framework, so answering the questions not only who should do these valuations and what should they do in terms of body of knowledge, but also how much of it should they do. How deep dive should they take?
Yes, and I want to note that this is for any fair value calculations that will go on a public company's balance sheet. So this is for SEC registrants in particular.
Okay, then I think on the next slide, so these are some new rules for goodwill impairment that's coming down the pike. This is from I think October 2015, so October last year, meeting from FASB to propose some simplification of the goodwill impairment test and also address some additional concerns. These valuations are exceedingly complex and often for how should I say that, to get intangibles that you can't really grip onto the balance sheet. And then on the next slide, private company alternatives. I think we had a question on that too. So there are some new regulations that came out of the Private Company Council, got adopted by FASB. So one is recognize only those intangible assets arising from non-cancelable contractual terms or other legal rights, even if they are separable. So you wouldn't recognize all intangible assets anymore. For example, customer relationships. But then on the other side, customer lists are being sold and can be sold. So they do have a value and they can be separated. For a lot of our clients, they're very ambitious, so they want to go public at some point. So they just do the full-blown purchase price allocation anyway, just to have it there. The other one, the 1301B, I think that was the question on, that allows actually the amortization of goodwill, so you wouldn't have to wait to impair it, but you amortize it, which obviously leads to less volatility in your earnings if you had to impair it. But I mean, you would still have to test it for impairment if there's a triggering event, but other than that, you would just amortize it. But again, this is only for private companies, and it's an alternative.
And as Gunther mentioned, that not all private companies are opting for this alternative. It's not a requirement, but it's an option. And those that are planning on hoping to achieve an IPO, say in the next 3 years, and then some of those who are maybe acquired by a public company would want to also have all their intangible assets valued, because that's just in case for the public companies due diligence. So just wanted to point that out.
Okay, then I think we still have some time to go over an engagement. So what do we actually do in a purchase price allocation, or what should you expect? So roughly it can be divided up into 4 steps: foundation, then a preliminary analysis, then a more detailed financial analysis. That's where the bulk of the work is done, and then brief stakeholders and document the work. And I think this also comes back to the SEC complaint that it needs to be documented. Any assumptions that are there, there needs to be support for that. And I think that's where a lot of allocations fall short. So in the foundation, obviously we review the obvious documentation, purchase agreement, merger agreement, any material contracts, the acquired workforce, but also management interviews and press releases. Press releases can be a tricky thing if in the press release it says, well, we bought this company because it's great technology, and then we start the purchase price allocation, and then there's little value in the technology. So that would lead to an audit question. Well, what happened? Then on the next slide, preliminary analysis. This is really where we select the intangible assets, the ones that would be valued, and the ones that would not be valued, and why not, or why we don't think they would be valued. And that's where we select the valuation approaches and methods. There are common methods for certain intangibles. There is some guidance, but it's not set in stone. So you would expect that there's a discussion which approach would make sense, or which approach we would pick in a specific valuation. Okay. This is also where we look at guideline public companies to get an idea of the industry. We would look at royalty rates, market data if necessary. So if we use a relief from royalty method, which is often used to value trademarks, and we would collect the specific target data. Then in the financial analysis, this has a couple of steps. We would, and I think Dirk showed that at the beginning, we start with the opening balance sheet at fair value with all the other assets. We look at the consideration that was paid for the acquisition. Cash equity could be equity. Then the question is, well, what's the value of that equity? Which might be easier for a public company, but it can be a little bit more tricky for a private company, specifically if they pay with preferred stock. So then you have a complex cap table on the acquirer side, where they pay with something that's where the value is not readily available. So it would need another valuation on that.
Unless there's been a recent financing of that preferred stock, but auditors specifically do not like it when management just states the value. That doesn't, that's not acceptable in the audit world anymore.
And it can be even trickier if the purchase documents say, well, we buy you for 30 million and we pay in common stock that's worth 30 million, which is a statement in an agreement, but that may not be the fair value of that purchase consideration, which then leads to a whole different ball of wax. Then, of course, there's a contingent consideration, or can be, which then also would need to be valued. So that could be a simple probability weighting, or it could be a Monte Carlo simulation for more complex works. There's one comment I would want to make is a lot of the purchase price allocation is based on a multi-period excess earnings method, which is a fancy way for saying a discounted cash flow analysis, but it's based on a financial forecast. And the contingent consideration is often also based on a financial forecast. So there needs to be some cross-reference, and we can't have the situation where we have one financial forecast and say, well, yeah, this is going to be at 100 million in 3 years, but we don't think they're going to get the earnout because they're never going to meet it. So there needs to be some consideration how that fits together. Then the analysis step 2, we would build the financial projections, and these would be asset specific. I think on the next slide, step 3, that's where we calculate all the rates of return. So we have the internal rate of return based on the acquisition. Well, this is how much we paid, and this is the cash flows that we expect in the future. Then we have the WACC, the weighted average cost of capital, based on guideline companies. So it's an external kind of cross-reference. And then we have selected discount rates for all assets, which in the end will get us all the way on the bottom to the WARA schedule, the weighted average rate of assets schedule. And ideally, all these 3 risk metrics kind of come together and are very close. Okay. And then finally, of course, we want to brief the stakeholders, discuss the valuation approaches with the auditors, get their buy-in. Or of course, if we are the auditors, then we would expect to be involved in that process, prepare a draft report, circulate, obtain buy-in, and then finalize the report.
One point I want to make is that we found it to be good practice to discuss with the auditors, not to just let them know after we're done what methods we're using, but to discuss the methods once we determine what intangibles we've identified and then what methods are appropriate. We'll discuss that with the auditors and make sure we're on the same page.
I think we had, do we have time for questions?
Actually, we were running very short on time, so we want to make sure that we review with you that during the seminar we covered an overview of the scope, requirements, and common valuation methodologies considered appropriate to value a company's intangible assets. And we also covered key PPA valuation considerations and requirements of the auditors. We got several questions, and thank you very much. We will have our presenters reply to you via email to the questions that you sent in, and we thank you for your interest in today's webinar. And also, if you want to reach out directly, you can reach out to Alex Floria on our team. His email is located there, and he will connect you with the appropriate expert on our Valuations and Equity Management Solutions team. Thank you again for joining Armanino, and we hope you have a great day.